continuing with Chapter 6, we're now going to get to our second learning objective or module. And in this second module, we're going to account for merchandise inventory costs, still using a perpetual inventory system. And in this module, one of the key things or the key issue is going to be our valuation methods. So we're going to focus on inventory valuation, methods. And of course, we know that there are alternatives here. That we'll discuss. The other, I think, more importantly, I think the other issue to deal with is that inventory valuation methods will not only have an impact on the balance sheet, but will also affect the income statement through the cost of goods sold. So when we think about the cost of inventory, at the end of each period, the two accounts, as I just said, that are critical and will be affected by the valuation method selected at the end of the period will be the ending inventory and the cost of goods sold. Now, the number of units at the end of the period, we know have to be verified by a physical count. If this is a periodic system, then the only way in which we know the ending inventory is, of course, is to count it. But under a perpetual system, we have a perpetual record of the units when we buy them, and they're deducted. You know, you scan them in at the receiving dock. They're scanned out of the cash register, and at every point in time, we know the units that we have on hand, but we still physically count them. So there's still going to be a physical count here because of the need to verify the perpetual records. And then the ending inventory is simply valued by multiplying the ending inventory on hand, the units on hand, by the unit cost. Now, let me just get to the whiteboard with you, and I'm going to show you that when you think about the ending inventory value, that is going to be equal to the units on hand. And we said even if you have a perpetual record, that has to be verified by a physical count. And that's going to be multiplied by the cost per unit. Now, the cost per unit will be inclusive of the invoice price plus any freight in minus any contra accounts that you have, or at least if you're on a perpetual system, the reduction of the cost of inventory for purchase returns, purchase allowances, and purchase discounts. So again, it's unit cost times the units on hand. Now, the units on hand are the units at the end of the year. These are current units on hand. We're going to find out that the question for us in this module is going to be what is the cost that we assign to those units on hand. And we're going to do the same thing with the cost of goods sold. When we look at the cost of goods sold, we have to determine the number of units that are sold during the period, and then we multiply that by the number of units sold by the cost per unit. So let me just go back to the whiteboard and get this set up, and I'm going to show you this on a PowerPoint slide in a moment. Is the units sold in the current period. This is at the end of the current period. It's the end of the current period. Units sold in the current period multiplied again by that cost per unit. And once again, I'm going to box this off because we've got to get back to this. This is critical, and it will depend on the inventory valuation method that we use. It's going to depend on the inventory valuation method we use. Now, in summary, again, as we've seen, I want to go back to the whiteboard, of course, but here, ending merchandise inventory, units on hand times that unit cost, and cost of goods sold is going to be the number of units that we sell multiplied by that unit cost. Now, at the end of the period, again, physically count the units to verify a perpetual record or determine the ending inventory if it's periodic. And the same thing will happen with the COGS or the cost of goods sold. Now, when we think about the unit cost, it is sometimes very easy to associate that with the particular units. Sometimes it's not. We do not have a problem, by the way, in any case, when the unit prices do not change during the month or during the period. It becomes pretty easy if you have, in this case, a constant unit cost. So there's not much thought process to go through, because if you know that the unit cost never changes, and if you know the number of units you sold, just multiply it by that constant unit cost. Or if you know the number of units you have at the end of the accounting period, once again, you simply multiply that by that constant unit cost. So let's take a simple illustration. And by the way, the problem is going to be much greater when we have a change in unit cost and you have an allocation problem. So going back to the whiteboard, you're going to see that if you think about the inventory problem, you could have beginning inventory and purchases. If we add those together, we have the goods available. For sale. And what's available is either in the ending inventory or the cost of goods sold. And of course, adding those together, it should equal the cost of goods available. Now, the inventory allocation problem arises when unit costs are different. So if you bought beginning inventory at $4, and if you have purchases at $5 or $6, there are going to be questions as to what goods are in ending inventory and what goods have been sold. But when there's a constant unit cost, then there's absolutely no inventory allocation problem. So in this case, it's a simple illustration. There's no inventory allocation problem. And by the way, the inventory allocation problem is the major issue in this chapter. So let's take this simple illustration. Again, we're thinking about, I guess, smart touch learning again. And notice that we have an inventory record for a certain tab or tablet. And the number is tab 0503, so it's model 503 of a tablet. And we have various units. You start the period with a two unit inventory. The cost is constant, so this is always the same. So it's constant at $350. You got 2 units on hand. On August 5th, that's the beginning of the month of August. August 5th, you buy 4 units at the same price. Got 6 units at that price. You sell 4 units. You've got 2 left. You buy 12, you now have 14, and you're buying them at the same price. You sell 10, you have 4 remaining. So there are 4 units on hand. You purchased 16. You sold 14, so inventory went up by 2. So that's the increase. You have a 2-unit increase. So it goes from 2 to 4 units. But because the units are acquired at a constant price, it does not change, then it is very simple that the units that are available for sale, the units that we begin the period with, plus those that we purchased, those that are available, and by the way, you've got, and I'll show you this in a moment, you've got 18 units available for sale, you sold 14, and the 4 that are left, but it's all at the same price. So there is zero or no inventory allocation problem. So going back to the whiteboard, what happened in this example is that we had 2 units at $350. So that is our beginning inventory, $700. We purchased 16 units, and that is also at the same or constant unit price. So again, we don't have an inventory allocation problem because the inventory unit cost does not change. And that's going to give you a purchase cost of $5,006. So what you have available would be 18 units at $350. And the total cost of goods available is going to be $63. That is the 7 beginning plus the purchases of 56 gives you 6,300 as available. Question is, how do you allocate that? Well, here it's very simple. And again, the allocation has to go to either, or both, I should say, ending inventory and the cost of goods sold. Now, this allocation is very simple because the unit cost did not change. Ending inventory, of course, affects the balance sheet. And cost of goods sold affects the income statement. So you have 4 units at $350. So our ending inventory is $1,400. And the 14 units that we sold, and we know, even if we didn't tell you that, if you had 18 with 4 left, assuming no spoilage or theft, there are 14 units that are sold. And the cost of sales is $49. Now notice that the cost of goods sold of $49 plus the ending inventory would be the sum that is equal to the goods available. So you have a fixed amount that is the sum of beginning plus purchases, but that also has to equal ending inventory plus the cost of goods sold. Now, in this case, without a change in the unit price, it's very simple to allocate the total cost of goods available to ending inventory and to the cost of goods sold. Now, more realistically, we're going to see that changes will take place in the unit cost. This is more realistic. And you have a problem here because it is now a question of having the ability to either identify what units are left and when they were purchased and their unit cost, and if you can assign that cost appropriately, as well as the units sold and the costs that are associated with the units sold. Now, obviously, with changing unit prices in a sophisticated computer system, it's very easy to identify. So you could, if you were able to, specifically identify the units in inventory and the units sold with a particular cost, so associate that directly, or we use a cost flow assumption. So typically, we don't use specific identification. It's more likely we're going to use a cost flow assumption, and a cost flow assumption is one of the inventory valuation methods. One of the inventory valuation methods. So, for example, now we've got changing prices. So now we've got a bit of a problem here because we don't necessarily know when we sell these 4 units, we're not quite sure whether we sold them out of beginning inventory or did we sell them out of the August 5th purchase, or is there some kind of combination that we've sold. So we're not quite sure where the units are coming from and where they're going to be sold. Now your beginning inventory, of course, is 2 units or 700. We know in this case, however, that the cost of purchases are going to be a little different. So in this case, now let me go back to the whiteboard. And in this example, your beginning inventory, and that's equal to 2 units times the unit cost, and that's total cost. 2 units, and the opening inventory was 350, so the beginning inventory is 700. Then you have some purchases. And the 2 purchases, if we go back to our diagram, the 2 purchases were made on August 5th for 360 and August 26th for 380. Okay, so your purchases are August 5th and August 12th, and these will be 4 units and 12 units at 360 and 380 respectively. So your purchase cost $14.40 on August 5, and on August 26th, on the 12 units times the 380, and that's going to be $45.60. So your total purchases are $6,000. That's the net cost. Now again, in here you could have, don't forget, you've got, when we talk about the unit cost, it includes the invoice price per unit plus any freight, and then less purchase returns and allowances and purchase discounts. All right, that all goes into the unit cost. The net cost purchased is $6,000, and the total cost of goods available is $67. It's the beginning inventory plus the purchases. So it's beginning inventory plus the purchases, and that would give you 67 as the total cost of goods available. Now, problem, of course, in this case, because there are different inventory costs, it makes it more difficult to determine what cost should be assigned to the 14 units sold and the ending inventory, which would be the 4 units. Because again, if we look at the total units available, it's 18. So I have 18 units available, and therefore I need to know how many units I've sold and how many units are on hand. I physically count. I count the inventory at 4, and I know that I must have sold 14, or I could have information indicating that I've sold 14. So once again, if I think about this allocation problem, beginning inventory plus the purchases will give me goods available. That has to be allocated to ending inventory and the cost of goods sold. So the question is not the units, but the unit cost. So these units are current units that I've either sold during a current period or I have remaining during that current period. And again, when we add these together, it has to balance. It's sort of like a scale, if you like. So once again, here, you've got 2 units at 350 or 700. Here we have 4 units at 360, 1440, and we have 12 units at 380. 4560. So my purchases, 16 units, total of 6,000. So the cost of goods available is 67. And the question is, what dollar amount per unit do I assign to the 4 units in ending inventory, and what dollar amount per unit do I assign to the cost of goods sold, or the 14 units? So the question here is the variable, I guess, X, which is the unit price, and Y, the unit price here as well. Okay. Now, the question, of course, is simple. Obviously, well, the first and the most simplistic case that we looked at is where we have a constant unit cost. Problem here is where we've got a changing unit cost. And if we could specifically identify them, that would be easy. So if I knew that the 4 units in ending inventory right here came from the batch of 360, then I know my cost, and it's quite simple. If I don't know that, I've got to make various cost flow assumptions, and these are the GAAP inventory methods. And these cost flow assumptions are as follows, and these are US GAAP. The last in, first out method is not acceptable under international standards, but the US GAAP standards are going to allow us to use specific identification, first in, first out, last in, first out, and a weighted average. Now, the unit cost follows the unit flow most exactly with the specific identification. In the other cases, with the first in, first out, or FIFO, last in, first out, or LIFO, or weighted average, we're making assumptions. So the method used to assign the cost to the units sold and the units in ending inventory may not exactly follow the flow of goods out of the entity or the flow of goods when they are sold. Now, the first, specific identification. Specific identification does have some use. It is most useful when you have a company that sells a very low volume of high dollar items or unique items. So this is key, that you're selling unique items, expensive or high, or very high dollar amounts, and at a very low volume. So examples would be automobiles. I mean, I can track a vehicle identification number, artwork, jewelry, and real estate. I mean, property, you have lot numbers, right? You have various lot numbers, so you know exactly where that is in the city, and you're able to track it. So specific identification would be simple. Now, specific identification is not always available, and companies may not want to use them because it may not give them the results that they're looking for in their financial statements. So, and for tax purposes, it may not be as useful as we'll see. So that's why we have the cost flow assumptions. Now, an example of specific identification would be in our simple illustration. We know we started with 2 units at 350, and then we had the acquisition of 4 units at 360, and then we had some units sold on August 15th. Now the question is, where do the units sold come from? And the assumption is that the units sold, well, one comes out of beginning inventory and the other 3 come out of the purchase on August 5th. So basically what we're saying here, and I'm going to put this on the table in a moment, but what we're saying here, it looks pretty simple when you've got specific identification, because they're saying that, okay, well, we know what we sold. We sold 1 unit out of the beginning inventory at 350. And we know that we sold 3 units. We sold 4 in total. So we know we sold 3 units at the next purchase. And that's 1080. So the total cost of goods sold is 1430 for this particular period. And we know that there are units remaining. We know that obviously if you had 2 units to start and 4 units are sold, you acquired 4, you had 6 units in total, you sold 4, so there are 2 units remaining, and we know that there's got to be 1 unit left in the beginning inventory and 1 unit left in the August 15 purchase. Because we know we basically said we sold 3 out of here, so there's 1 left at 360. And we know that if we sold 1 out of the beginning inventory, there is 1 left at 350. And we're identifying them specifically. So we've got 710 as our ending inventory. Ending inventory is 710. Cost of goods sold is 1430. Now, we can see this on the table. On the next slide on specific identification. So let's try to follow the flow of the information. So once again, we started the units, or started the month off August 1st. We started the month off with 2 units at 350 or 700 in our beginning inventory. On August 5th, we purchased 4 units at 360. 1440 is going to be the cost of the goods purchased. Now, the total that's available at this point cost of goods available for sale is the sum, or the 2140. Now, we now sell on August 15th, we're selling 4 units. The question is, where do they come from? Well, our assumption is that 1 of the units is coming out of the first batch at 350, and 3 of the units are coming out of the second purchase, or the purchase for the period, at 360. So when we multiply these through, we get our cost of goods sold of 1430, and when we subtract those from the balance of inventory, the ending inventory is 710, as we looked at earlier. Now, this is only a partial illustration. To continue this, in the next period, we know that on August 26th, we bought another 12 units, and these were acquired at a cost of $380. That's from our original example. And then on August 10th, we sell 10 units. And the assumption here, and by the way, this is quite simple because, for you as a student, because I would have to tell you, exactly what units you sold. So now I'm telling you that in your cost of goods sold, you sold 1 unit at $350, so you sold that out of the beginning, the original August 1st balance. And I'm going to put this up on a table in a moment. And then you have 9 units that were sold. So if you sold 10, 1 out of the beginning, the rest, the 9 units, were sold out of the August 26th purchase at $380. $3,420, so $3,770, $3,770 is your cost of goods sold. Now, again, you're able to specifically identify the exact units that you sold, and you'll know the exact units you have on hand. So once again, looking at the table, we know that going forward now for the 12 units that we've sold, we have on August 26th, we purchased 12 additional units, and we know we sold 10 units in total. Sorry, let me go back. Here it is. Sorry. We know that on August 26th, we bought 12 more units, but we sold 10 units here on August 26th. So that, or August 31st. So that one of those units is coming out of the beginning inventory at $350, and none of the units are coming out of the August 26th purchase. So we know that the units are going to be valued, or the cost of goods sold for these units is going to be the sum of the $350, and of course the 9 units at $380, or the $3,420. So we know that the cost of the August 31st sale, we know that's going to be $3,770 as we calculated earlier. Now, in total, for the entire month of August, if we're using specific identification, and we'll look at a perpetual inventory record in a second, if we're looking at specific identification, we know that we started the year with 2, we purchased 16, that's 18 available, and we sold 14, so there should be 4 units left. So there should be 4 units in ending inventory. And the question is, where do the ending inventory units come from? Well, we know there's a total here of 1,500. So what makes up the ending inventory? Well, the ending inventory will be 4 units. Well, there's 1 unit left here because you know you had 4, you sold 3. So there's 1 unit left there at $360. And we sold 9 out of the August 26th purchase, so there's 3 left, and that's going to be at $380. So the ending inventory is going to be equal to, now we know the number's right here at 1,005, but to verify it, it's 1 unit at $360, and it is 3 units at $380, or $1,140. So the ending inventory under specific identification is 1,500. Now moving to a perpetual inventory record, this is the way it would look more formally, and you see this obviously in your textbook as well. We wind up with the same results, beginning inventory plus your purchases for the year. We said that the amount available would be in total for the month of August. That's the cost of goods available. How is it allocated? 52 to the cost of goods sold and 15 to ending inventory. And of course, that should equal 6,007. So going back to this diagram here, what we did is we took the total of goods available, in this case of 6,700, and the allocation here, these 4 units on a specific identification. Specific identification tells us that 1,500 goes to ending inventory and 5,200 goes to the cost of goods sold. So on the specific identification, 1,500 goes on your balance sheet and 5,200 is recorded on your income statement. Now, specific identification may not always be possible. We know we have, obviously, optical scanners that could track costs directly to a particular unit so that it's very, very simple that a unit gets scanned in when it's received. When you sell it, you go to the cash register, they scan it, they know it's out of stock or they know that you've sold it, so they take it out of the inventory and they will include it as part of the cost of goods sold. Very simple. There's not much of a problem there. Even if you don't meet the typical reasons why you would use specific identification, and that is low volume of very expensive items and maybe sometimes unique items. Obviously, every car is unique because it has a unique vehicle identification number. So the bottom line is, yes, it's probably available. A specific identification is probably available for almost every type of business. However, some businesses, it may not be practical if they don't have an optical scanner and they're selling a very high volume of very different items. Even if it's a homogeneous item like the sale of liquid fuel or natural gas, it's very hard to identify the specific units that you've sold. In addition, even if specific identification is available, you may not want to use it again because of some practical implications such as taxes as well as financial reporting effects. So therefore, we have available to us several cost flow assumptions. And the first cost flow assumption is going to be FIFO. Remember, it's first in, first out, last in, first out, and average. First in, first out assigns the most recent cost to ending inventory and the oldest cost to the cost of goods sold. Now, the most recent cost to ending inventory means that on your balance sheet, you're going to reflect an amount of inventory that's very close to the current replacement cost. So that's a good thing. So your inventory on your balance sheet reflects current costs. So it is valued at an amount that is useful to a financial analyst or any financial statement user because it reflects the amount that we could expect to replace this item. However, the cost of goods sold is at the oldest possible cost, and therefore it may not be quite as useful because the costs are older and could be lower than the cost that you would pay today. And maybe sales prices have gone up as well with inflation. So as a result, it may not be quite as useful as if you had the current cost as well on the income statement. And we'll talk about that, but these are the trade-offs. And you'll always get a trade-off between the balance sheet and the income statement. So essentially, you're going to use FIFO, and it makes sense that the first goods in are the first ones out. So therefore, the first goods in are the first ones out. So the oldest costs go to the cost of goods sold, and what's left is the most recent. So probably you would use FIFO for most companies because they're subject to style change. Well, most companies' items are subject to style changes or technological change. You could also have to worry about obsolescence. And also goods subject to perishability. So goods could be perishable, and you would need to sell them first. So FIFO makes sense for businesses that sell products that are subject to rapid style changes, technological changes, obsolescence, and if their goods are perishable. Now, we're going to take a look at an example. Let me read this through, and then we're going to go over to the table to see how this works. But again, in our assumption, in our example, we assume that on August 1st, we begin the period with 2 units that cost us $350. On August 5th, there are 5 units acquired at $360. August 15th, we sell 4 units. And if this is FIFO, first goods in are the first ones out. So these 2 units have to come out of the opening layer or the opening balance of inventory. So the 2 units sold out of the 4 units has to come out of the beginning layer. The rest will come out of the August 5th purchase. So the cost of goods sold are the oldest. And again, as I said, the August 5th purchase will pick up the rest of that sale. August 26th, the company buys 12 more units at $380, and then it sells 10. On a FIFO basis, what's left? Well, you have nothing left in the beginning layer, and we know that there are 2 units left from the August 5th purchase. So we know that on our sale, the remaining units would come from, first you're going to sell the remaining units from August 5th, and then you're going to sell 8 out of the August 26th purchase. But to see this more clearly, let's take a look at our illustration. And start the year with, or the month, August 1st, 2 units at $350. Then on August 5th, you buy another 4 units at $360. Here's the sale. You sell on August 15th, you sell 4 units. And the assumption is the first goods in are the first ones out. So you sell 2 out of the beginning layer at $350, and the other 2 come out of the August 5th purchase at $360. We're going to formalize this in a minute. Then you buy 12 units at $380. Next, on August 31st, you sell 2 more units, and those have to come from the August 5th purchase. So if you're selling 10, the first 2 come out of the August 5th purchase. So it's the first ones in or the first ones out. We've already sold those on August 15th. And now we sold 2 of those on August 15th and 2 on August 31st. And the other 8 come out of the August 26th purchase. Now, of course, the oldest cost were assigned to ending inventory, and the most recent cost would be, the oldest costs are assigned to cost of goods sold, and the most recent costs are assigned to ending inventory. These are the most recent cost of $380. You got 4 units left. So FIFO ending inventory reflects replacement cost. Reflects the current replacement cost. So the way this works, again, the oldest costs are going to the cost of goods sold. As you sell the units are going to come out in FIFO order. First ones in are the first ones to be sold. That means that the most recent units are left. Ending inventory is going to be at your most recent units. And again, your allocation, if you remember, is going to be equal to the total of 67. 5180 is cost of goods sold. 1520 is going to be the cost of your ending inventory, or the value of your ending inventory. Has to equal the full 6,700. So you have 6,700 and you've got 5,180 sold, and ending inventory is going to be the 1,520. The cost of goods sold is going to be, go back to that, sorry. Cost of goods sold is going to be the oldest cost, and ending inventory is the most recent. And again, the total has to equal 6,700. Now, we're going to go through a formal perpetual record and verify those transactions again, but I think this diagram is going to be useful for you because it'll help you follow the flow. So as you're selling them, the green units are your first purchase. The red units are selling them from the second purchase, and the blue is coming out of the August 26th purchase. So green comes out of beginning inventory, first purchase is red, and the August 26th is the blue. Now, that makes it easier to follow, but just make sure you understand the logic. FIFO assigns the most recent cost to ending inventory, the oldest cost, the cost of goods sold. Now, no matter what costs are assigned to the units, make sure that you understand that the units that are on hand are going to be the current unit. So in this case, the FIFO cost flow follows the unit flow. So in this case, FIFO cost flow does a very good job matching the unit flow. So the units that are on hand are the current units. You've sold the oldest. And again, that is because you want to avoid being subject to obsolescence due to style changes, technological changes, or spoilage due to perishability. Let me go to the whiteboard again, and let me remind you that this was the specific identification. Now that we go to FIFO, the FIFO ending inventory is 1520, and the FIFO, this is specific identification, and I'm going to give you a summary table, so don't worry if this is a little bit informal. And the cost of goods sold is 5180. So notice already, depending on the accounting alternatives, you get a different balance sheet on the ending inventory and a different cost of goods sold on the income statement. Now, let's go to a formal perpetual record for FIFO. And again, what was happening, to explain this, once again, is that beginning inventory, 2 units at 350 or 700. August 5th, we buy 4 units at 360, 1440. Right now, the balance of inventory is 2140. Now we sell 2 units, and again, we sell 4 units, and again, 2 units have to come out in FIFO order. First one's in are the first one's out. The cost of sales is the oldest. It comes out of the first batch or beginning inventory at 350. The second 2 units come out of the most recent purchase, which is at 360, and therefore it is the 720. So it's the oldest cost going to the next oldest cost. Then we buy 12 units at 380 on August 26th, 4560. So notice what happened here is that you had 700, then it goes up to 2140. You sell 1420, leaving you a balance of 720. Now you buy 4560. That brings that up to 5280. So here, what we did is when we subtracted 1420, we got 720. Now when we buy 4560, we've got 52.80. And then finally, we sell 10 units. And in selling those 10 units, we know that we've already sold the 2 units in beginning inventory, or at least the cost associated with those 2 units. We also sold 2 units out of the, or at least using the cost of the 2 units out of the August 5th purchase. Next, when we sell the 10 units here, going in FIFO order, cost of goods sold is the oldest cost. The only older cost available is from the August 5th purchase. So those 2 units are sold at $360. And then 8 units are assumed to be sold from the August 26th purchase at $380. So your cost of goods sold is $37.60. If I subtract the $37.60 here, I wind up with the $15.20 ending inventory. And of course, cost of goods sold is $51.80. So to summarize, we know that ending inventory is the newest or the most recent cost. And we know that FIFO has the cost of goods sold at the oldest. Comparing FIFO to LIFO. Let's go to LIFO now. LIFO is just the opposite. LIFO would say the last goods in are the first goods out. Question: what companies would use the LIFO basis? Well, it's probably very limited, and maybe an example would be companies that hold a base stock. For example, mining. So a mining company. So, you have a coal, let's say, or a mineral, gypsum, being piled up. And as we use it, we take it off the top. So the last goods in are the first ones to be sold. So that means that the cost of goods sold are going to be the most recent cost, whereas the ending inventory is going to be oldest cost, just the opposite. Just the opposite. So that if you're in a period of inflation, when costs are increasing, then we would expect that LIFO would give you a higher cost of goods sold and a lower net income. So LIFO would give you a higher COGS and a lower net income because they're taking their cost from the most recent, and here we're talking about inflation, the most recent inflated cost. Now, this is not necessarily a bad thing because if LIFO is used for tax purposes, it will allow us to take a higher tax deduction than last in, first out, and a higher tax deduction than the specific identification. So that's what I meant before, that even though you may be able to use specific identification, you will probably not do so, particularly for tax purposes. And when you think about the tax regulations, there is something known as a conformity rule, which we'll see. And again, what you're trying to do here is, since you have the higher cost of goods sold and a lower net income, that's going to lower taxes also. Now, although we have separate books for GAAP and tax, there is something known as a LIFO conformity rule. LIFO conformity rule. And that's coming from the IRS, Internal Revenue Service. It's a U.S. rule. U.S. GAAP is affected by this. So the Internal Revenue Service in the United States has a LIFO conformity rule, which says that LIFO, if you want to use it for tax, you have to use it on your books. Okay, so LIFO for tax means that you have to use it on your books as well. Let me see if I can make that a little bit clearer. Okay, so LIFO for tax means you have to use it for your books as well. Now, differences: FIFO assigns the most recent cost to inventory, old cost of goods sold. LIFO assigns the most recent cost to COGS, and the inventory is going to be undervalued because they have, in a period of inflation, the oldest cost. Now, here's our example again, and we don't necessarily need to repeat this. So August 1st, we have the beginning inventory with the August 5th purchase, the August 15th sale. Now, of course, now the allocation will change. We also know that on August 26th, we purchased 12 units with 10 of those sold, or 10 units sold, not necessarily those 10, but we'll see when we look at LIFO which units were sold. And of course, when we do the example in a moment, it will tell you that if you're assuming that the last goods in are the first ones out, that means your older units. So if you look at this last slide before we do the example, there are 4 units in ending inventory. We know that from our previous illustrations, and those 4 units are going to carry a cost from beginning inventory and the next purchase. Now, you know, the next oldest purchase. Now, it doesn't mean that with LIFO you've got old units on hand. It simply means you're assigning older costs to current units. So let me just repeat that. It gets sometimes confusing for students seeing this the first time, that when we use LIFO, we're assigning the oldest cost to units in ending inventory. So let me say that again. We're assigning old cost to current units in ending inventory. So it doesn't mean, for example, that the 2 units are still on hand in the beginning inventory. It simply means we use the cost that existed in that beginning inventory to value the inventory, the oldest cost. So now let's take a look at Perpetual LIFO. Once again, let me set this up. And this was in the narrative on the other slides that you can always go back and read, but it's here. Start the month with 2 units. Start the month with 2 units at $350. August 5th, we buy 4 units at $360. Now, on August 15th, we sell 4 units. Last in, first out. The last goods in were August 5th. They're the first ones to be sold. So that unit sold. We sell 4 at $360. Gives us a cost of goods sold at $1,440. Notice the cost of goods sold are your most recent costs. They are not inclusive of the beginning units. Then on August 26th, you buy 12 at $380. And when you sell 10 units, again, last in, first out. The last ones in are at $380, and you sell 10 at $380. So the cost of goods sold is going to be at $5,240. And the ending inventory is $1,460. Now, of course, you add those up. It's got to equal the total goods available, total cost of goods available of $6,700. Now, what's left in inventory? Under LIFO, it assigns the most recent cost to the cost of goods sold, the oldest cost to ending inventory. So the first oldest cost would be 2 units at $350. Now, it doesn't mean that these old units are still in inventory. We're simply saying we're going to use $350 to assign to our ending inventory. Then we've got 2 units at $380. because if we sold 10 out of here, there are 2 units left. So that's where the 4 units come. Now remember again, when you look at the beginning inventory plus purchases, you had 18 available minus what you sold, you have 4 units in ending inventory. So we know we have 4 units in ending inventory, and we know that 2 of those units are coming from the first cost of $350, and the other 2 are coming out of the August 26th purchase. So ending inventory is going to be at $1,460. Now a formal perpetual record is here, and it's going to show you exactly the same thing. I mean, again, you've got 6,000 units purchased. You started the period with 7. So the total available is 67. And out of that 67, we allocated 5,240 to COGS and 1,460 to the ending inventory. Now let's go now to this document camera or the whiteboard, and notice that if we look at ending inventory, specific identification 1,500 under the first method, FIFO, LIFO ending inventory is going to be less than FIFO. FIFO most recent, LIFO the oldest. So the ending inventory here is 1,460, and the COGS under LIFO is going to be 5,240. So notice a higher cost of goods sold, and therefore a lower net income and a greater tax deduction. Now, somewhere in between the extremes of LIFO and FIFO is the average cost. So our last cost flow assumption is going to be the average cost. Now, the average cost method is on a weighted average basis. It's called a moving average. And first of all, when would you use average cost? You'd use the average cost method when you're selling a high volume of homogeneous goods. You could also use it for immaterial inventories and supplies. So the average cost approach, or the weighted average approach, is useful when you sell a high volume. So its used, or its use, is for companies with a business that has a high volume of a homogeneous product also for immaterial inventory and of course supplies. Can use the average cost method. After each purchase, an average is taken. When the item is sold, we use the average cost at the time of sale. And again, the inventory is going to be valued after the sale, and of course it's costed at the average at that time. So we take a new average every time there's a purchase, and when we sell the product, we use that existing or the average that exists at that time. When we calculate the weighted average cost per unit, it is very simply, at any point in time, the total cost of goods available divided by the number of units available. And as I said, every time you purchase, you recompute the average. So the average cost, or the weighted average cost, is very simply the ratio of the total cost of goods available over the number of units available. and it is computed after each purchase. So here's a very simple example. Let's assume that on August 20th, and again, we're breaking away from our continuing illustration, but just to make sure that we've got a good handle on weighted average. So let's assume on August 20th, the company has 27,900 goods available for sale, and they have 12,400 units available. The average cost is $225. A very simple illustration, but that's all we need to do. However, we have to do this and make this calculation on a moving basis. So every time there's a purchase, that average cost is determined. And that average cost per unit, the $225, is used as the cost of sale if a sale takes place immediately after the new average is calculated. So when the units are sold, they're removed from the inventory at the average cost. So the number of units decline, but the average will stay the same. It does not change the average cost. And we'll see this in our example. And we're going to go to our table in a moment, but this is a little different, so it's certainly worth going over in detail. So when we started the month of August, you had the total cost of goods available was the beginning inventory. You had 2 units, so your average cost was $350. Then when you purchased 4 units on August 5th for $360, it added $1,440 to your total, and 4 units were added as well. So the total cost of goods available, beginning inventory of $700, purchases of $1,440, it's $2,140. There are 6 units in inventory at that point, so the average cost is going to be $356.67. And of course, the way you get that, $2,140 divided by the 6 units. $356.67. And there is no change in the average cost when you sell something until a new purchase is acquired or new inventory is acquired. So on August 15th, we had 4 units sold, and basically you're going to sell them at that average cost. So again, you're going to sell them at the average cost. If there is a purchase, when you added 12 units, then of course that would change it. That's later. But right now, when the units are sold, they're going to be sold at the average cost of $356.67, which we calculated here earlier. So now it's removing them at that cost. Okay, so when you sell 4 units, the price is $356.67, and therefore the cost of those goods that we sold were $1,427. And then the 2 units remain are still at that unit cost. Then when we buy the 12 units, as I said before, now you've got a new unit cost to calculate. So now you'd have to calculate the new unit cost at that point. The new unit cost, which I'll show you in a moment, will be reflecting the balance that we had on hand plus the dollar value of the new units that we acquire. The average cost is now $376.64, and when we sell the 10 units, it's going to be $376.64. We also know that the ending inventory is going to be 4 units, and those 4 units are going to be made up of the average cost of $376.64. Multiplying that by 4 gives you the ending inventory value of $1,507. So multiplying this by the 4 units in ending inventory would give you that balance. Now, looking at this on a perpetual record, I think it's a lot easier than the narrative, so let's make sure we spend some time on this. 2 units at the average. Now, this is an average cost of $350 or $700. Now, we purchased 4 units at $360. That cost is $1440. But notice what happens here. Your total cost is $2140, but there are 6 units on hand. Your average cost is $356.67. When you sell 4 units, you remove them at that average cost. So the cost of goods sold is the average cost of $1427. And the remaining units, there's 2 units left, it is at that same average. So the average doesn't change with the sale, it changes with the purchase. Let me say it again. Anytime you purchase something, the average cost changes. When you sell something, the average cost does not change. So now the ending inventory is $713. On August 26th, you buy 12 units for $380, $45.60. So now when you add in the $45.60 to your $713, you now have a total cost of $52.73. There are 14 units on hand, so that the new average cost is $376.64. And then when you sell the 10 units, that's the cost you use, $376.64. Out of the total cost available, and remember the total cost available is constant in our example, $6,700. That's the total available. Using the weighted average approach, allocates $51.93 to COGS and $15.07 to ending inventory. And remember that that will equal the sum of the cost of goods sold and the ending inventory will equal $6,700. Or the goods available. Now, another thing to notice with the average cost is that we say it's a weighted average. What are the weights here? The weights are really the quantities in each purchase. So the quantity, these are the weights. So each price is weighted by the units. So the more units you buy, it gives more weight to the 380. So you notice as you're moving up, as prices are going up, it doesn't necessarily mean that the average cost will go up. It's really going to depend on the number of units. So since you bought 12 units at such a high cost at 380, that's going to cause the average to go up. If you bought, for example, more units at 350, or in fact, if most of your units were acquired at 350, the average would be lower. So the quantity, the units, are the weights in that weighted average. So again, the new average cost computed after each sale, used to cost out the next sale, and a sale does not change the average cost. Now, to finish this example, and we will be looking at a formal table in the next module, notice that the weighted average let's take COGS first, it's going to fall in between the two extremes. It falls in between at $51.93. It falls in between the FIFO COGS and LIFO COGS. Remember, we're always allocating the constant $6,700. And in the ending inventory, will also fall between the two extremes at $15.07, where FIFO is the current cost, giving you the higher ending inventory value. LIFO is the oldest cost, giving you 1460. Weighted average falls in between the two logically because it is going to be the mid ground or the average of the two. Now, make sure you go over those calculations. Make sure you're able to calculate ending inventory under a specific identification, but most importantly, under our cost flow assumptions of FIFO, LIFO, and weighted average. And in the next module, we're going to now go through an analytical comparison of the results that we just covered.